Hi, so welcome to Model 21. Model 21. Gradually, we are drawing closer to the end of financial reporting. That is Consolidated Financial Statements, and we'll be looking at, or we'll be going to look at a couple of accounting standards here. IAS 27, that is Consolidated and Separate Financial Statement, and IFRS 3, Business Combination. I'll be listing a couple of them as well as we go through. Now, the principle of consolidation comes in place where organizations or one organization invests in another organization. So, let's say one company A, right, buys the shares in another company called Company B. So, let me put the structure up like this. So, Company A buys the shares in Company B. Then, let's say that Company A also has another investment in Company C. Let's say that Company A buys the equity shares of the company for 75% share of the company. Then for Company C, it buys only 30% shares in the company. Now, what is going to happen is that the parent company or the company making the investment is what we call the parent company. Now, if the parent company buys more than 50% share, if you remember what I did under investment in associates, I told you that when a company buys more than 50% share in the company, then the investee company becomes a subsidiary. What it means is that the parent company now has control over the net assets of the company, over the financial policy and operational policies of the organization. But the Company A, who is the parent company to B, has an investment worth 30% in the Company A or in Company C. But in this case, since the shares in the Company C is below 50% but more than 20%, it means that Company C is seen as an associate. So if you remember clearly, we said that investment in associates should be accounted for using what we call IAS 28, and we are going to account for it at cost. So when the Company A, that is the parent company, wants to prepare its financial statements, it needs to prepare a group financial statement. What does it mean? It means it needs to prepare its own financial statement. Then because it has more than 50% shares of the Company B, and the Company B is now a subsidiary, it is going to also add the shares of the Company B to its, or the assets of Company B to its financial statement, and then the investment in the associate company, that is Company C, will also be accounted for using the equity method or the cost method. So this means that Consolidated financial statement refers to preparing one single financial statement for the three different companies. So we're going to prepare one single financial statement, and that is what consolidation is all about. So when a company invests more than 50% or has more than 50% share of the company, we say that the company has control. Don't worry, there are various forms of control, not really about buying 50% share of the company. We will look at other situations that bring control to the organization, but fundamentally it is about acquiring 75% share, or is acquiring more than 50% share of the companies in what of the shares in another company. So consolidation is about bringing all these financial statements into one financial statement. But why would the parent company be interested in the preparation of consolidated financial statements? Why would he say that, oh, okay, I have investment in the subsidiary, I have investment in an associate, so let it end there? Why will he be interested to prepare a consolidated financial statement? So the following are some of the reasons for the formation of group companies, and as such for the preparation of consolidated financial statement. The first one is to exploit tax advantages. Yes, because when you are a group of companies, the taxes will be netting off in relation to each other. Goodwill associated with large organization. Now, if this company has a share in a subsidiary and has a share in the C, that means that the goodwill of the parent company is high. It has a lot of investment, so its reputation and its non-current assets in relation to goodwill is going to be high. Exploitation of intra-trade or intra-company trade, that is intergroup trading, and we'll be looking at that later on as well. But what it means is that now the parent company can buy the goods from the subsidiary, and the subsidiary may sell the goods to the parent company at a price lower than what they would have sold to the outsiders, and they will buy the goods from the subsidiary at a very low price than what they would have bought it from an outside company. So to exploit the advantages of intercompany trade. Then the next one is about business integration. People spend or want to find or prepare form group of companies so that they can integrate the company, so that if we are a group of company and we are in insurance, we are in manufacturing, and we are in banking, we are in investments and other aspects or sectors of the economy, what it means is that all companies will be insured by the insurance company. If any of the companies is requiring loan, it will go to the bank, then take the loan. Then if the manufacturing company wants to save its money, it saves it with the bank. So what it means is that the money will be circulating in the group of company, and it wouldn't go to any outside company. So these are some of the important reasons why group of companies are formed by a lot of companies around the world. Now, when we are looking at preparation of consolidated financial statements, we have to look at some accounting standards that have to be used. And I've mentioned 3 of the accounting standards already. IAS 27, that is separate and consolidated financial statements. IAS 28, that is investment in associates. IFRS 3, that is business combination. And then IAS 24, that is related party disclosure. Now, there are some organizations that the business doesn't necessarily have investment in, but it transacts business with the organization, or it has relationship with the organization, and they impact or they have an exchange in relation to how activities will be done by the 2 companies. So in those cases, we need to recognize what we call, or disclose what we call, related party transactions, and it is more or less in corporate reporting than it is in financial reporting. So the next slide we want to consider is to look at some definitions. I've already explained what a parent company is, what a subsidiary is, what an associate is, and what control means. But let's look at what we have there. A parent company is an entity that has one or more subsidiary. A subsidiary is an entity that is controlled by another company. A control is identified or defined as the power to govern the financial and operation policy of an entity so as to obtain benefit from its activities. So once the company can influence the financial and operational activities or policies of another company, that means that the company has what? Control over the other company. But this is the nuggets that you have to note. Note, however, that control can also be exercised and will lead to a parent-subsidiary relationship when less than half of the voting rights of the investees are owned by the investor. So that was what I was saying, that it is not necessarily about acquiring or purchasing of 50% or more shares of the investee company, but control can arise in other various conditions. 1, the parent company has the power over more than 50% voting rights by virtue of agreement with other investors. So let's say, for instance, that the parent company buys only 30% share in company C, which is supposed to have been an associate. But let's say that the parent company negotiates with the other shareholders of company C and tells them that, listen, give me your voting rights, let's agree, we will make better decision for you. So by virtue of that agreement, if those other shareholders or those other investors transfer their voting rights to the parent company here, then that means that even though we have 30% share in company C and it's supposed to be an associate, it will be treated as what? A subsidiary, because we have control by virtue of an agreement of having more than 50% of the voting rights in the company. The second thing is the parent has power to govern the financial and operating policies of the entity by statute or by an agreement. So if the organization or the parent company has the power to govern the financial and operating activities by virtue of law, statute, or by an agreement, as we mentioned earlier. So maybe sometimes there can be a law that, for instance, if a multinational company buys 50% shares or 30% share in another company, which is a startup company, definitely you don't know the industry much. So by law, there may be regulations that that company would have to control everything that you do. So in that case, even though the investment qualifies to be an associate or to be treated according to IAS 28, the investment will be treated rather as business combination, IFRS 3. Then the next thing is that the parent has the power to appoint or remove a majority of the members of the board of directors. So if the parent doesn't have 30%, doesn't have 50% or more shares, but the parent company has the power to remove majority of the board of directors, then in that case we say that that company is what? A subsidiary, and we prepare a consolidated financial statement for them as well. Then the final thing is that the parent has the power to cast a majority of votes at meetings of the board of directors. What it means here is that the parent company has more members on the board, okay, of the company. So even though we have only 30% share in the company, we have more directors on the board of the company. As such, we have a majority decision-making role when it comes to any decision by the board in the organization. So these are the other 4 conditions or circumstances under which, even though a company may have less than 50% share of investment in the investee company can become a subsidiary, and there will be what we refer to as parent and subsidiary relationship. The next thing we need to look at is group. A group simply refers to a parent and all its subsidiaries together. So when we say a group, we are referring to the parent, its subsidiary, and then any associate investment in that case. But we need to understand that the parent may produce its own financial statement in which it will show the investment in its subsidiary as or associate at cost, or in accordance with IAS 39, or in accordance with IFRS 5. So the parent company, as I mentioned, will prepare its financial statement, and when they prepare their financial statement under the non-current asset, they are going to disclose their investment in the subsidiary or in the associate at investment at cost. Or if they want to sell off their investment in the associate or the investment in the subsidiary, then they will now de-recognize it as a non-current asset as a current asset according to IFRS 5 in that case. That is like a discontinued operations. So consolidated financial statements are simply the financial statements of a group presented as that of what? A single economic entity. So we're going to prepare, when we say consolidation, we're going to look at the financial statement of the parent, financial statement of the subsidiary, then financial statement of the associate, the portion of which that relates to our investment, and prepare a single financial statement as though the 3 companies are actually just one company that a company has. Then it is not all organizations that can prepare financial or a group financial statement. Not all organizations qualify to prepare a group financial statement. So a parent company need not present consolidated financial statement if all of the following conditions exist. So if a parent company has an investment in another company, but the following conditions exist, then that company cannot prepare a group financial statement. 1, the parent itself is a wholly owned subsidiary. So if, like for instance, this subsidiary is a wholly owned, 100% owned by another company, then they also invest in another company, this subsidiary cannot prepare a group financial statement because they themselves are owned by another company. 2, the parent securities are not publicly traded. So if the parent securities are not publicly traded, in other words, their shares are not traded on the Ghana Stock Exchange market or on the stock exchange market, then the company cannot prepare a group financial statement or a consolidated financial statement. The third thing is that it is not in the process of issuing securities in the public securities market. Now, if you are not listed on the stock exchange market, you can still prepare a group financial statement, but you will prepare it if you are in the process of issuing securities on the securities market so that the public can have access to your financial securities or your shares. Then the final thing is that the ultimate or any intermediate parent publishes consolidated statements that comply with IFRS. So these are conditions that must exist in relation to how a company qualifies to prepare a consolidated financial statement. The next slide we want to consider is exclusion of a subsidiary from consolidation. Under what circumstance will a subsidiary be excluded from the consolidated financial statement of the parent company? So IAS 27 gives a very strict condition under which a subsidiary can be excluded from consolidation. In the past, subsidiary were excluded under the following conditions. One, dissimilar activities. So if the parents and the subsidiaries are not undertaking the same activity in the past, they were excluded from the preparation of consolidated financial statements. Now, exclusion on the grounds of dissimilar business activities is not justified as better information is provided by consolidating such subsidiary and disclosing additional information about the different business activities of the similar subsidiary. That is using IFRS 8 operating segment. So even though in the past we are not supposed to consolidate organizations that are not in the same industry or undertaking the same activities, it can now be consolidated because there can be a disclosure of financial information. 2, when a subsidiary operates under a severe long-term restriction which significantly impairs its ability to transfer funds to the parent. So normally if we have a subsidiary in a country which there is legislation, strict legislation that the subsidiary cannot transfer money to the parent company which is in another country, then in that case we cannot prepare what consolidated, or we cannot include that in the consolidated financial statement. However, exclusion is permitted under this condition only when the parent loses control over the subsidiary as a result of the restriction. So even though in the past this was there, now it is no more there, but it will be there if the subsidiary or if the parent company loses the control. But as far as we still have the control, the fact that they can't transfer funds to us does not mean we won't include them in the preparation of our consolidated financial statements. Then the next one is where control is intended to be temporal because the subsidiary is acquired and held exclusively with a view to its subsequent disposal in the near future. So this is where the control is intended to be temporal. So the parent company invests in the subsidiary, but they invest in the subsidiary so that they will sell it off. So it is like an investment available for sale, or a financial instrument available for sale. So in that case, what they are going to do is to account for it under IFRS 5, that is non-current asset held for sale and discontinued operation by the parent company, because the control is temporal. Now, all companies constituting a group should use the same or uniform accounting policies so as to facilitate the preparation of consolidated financial statements. Adjustments are needed before consolidation where a member of the group uses different accounting policies for some transactions. So usually one of the things that must be met is that all the members in the group, or all the companies in the group, must use the similar or the same accounting transactions or accounting policies. But where a member in the group is applying a different accounting policy in relation to a specific transaction, then an adjustment has to be made to the accounting policy of the subsidiary in line with the parent's accounting policy so that we can prepare a group financial statement. The next slide we have to take care of is called reporting dates. Now, some companies in a group may have different reporting dates from that of the parent company. For the purpose of consolidation, such companies may prepare additional financial statements to the reporting date of the rest of the group. If this is not possible, IAS 27 allows for the use of financial assets prepared to at most 3 months, either earlier or later from the consolidation date, and adjustment made for significant transaction between the dates. So what we are saying here is that usually if we are going to prepare group financial statements, all the companies in the group must be reporting at the same year ended. But we know that that is not true in reality. So what IAS 27 allows is that some companies can prepare their financial statements 3 months after the year end or 3 months before the year end, so that we can prepare the group financial statement. But any event that occurs after the financial statement are prepared or before the financial statement are prepared has to be captured or taken care of. The next slide is exclusion and inclusion dates. Now, some subsidiaries are consolidated from the date of control, passing to the parent to the date. No, subsidiaries are consolidated from the date control passes to the parent to the date control is lost. So usually when we talk about the reporting date and the date of inclusion and date of exclusion, immediately we buy the subsidiary, immediately the parent invests in the subsidiary, that from that date there is a reporting in the relation to the financial statement of the company. But it also ends when we lose the control. So assuming we have 75% share in a subsidiary and then we sell 50% of the subsidiary, that means that now we have lost control of the subsidiary. As such, we cannot prepare a consolidated financial statement. We will only consolidate up to the date that we were having control, and any date after the control was lost cannot be consolidated or will not be included in the group financial statement for the parent company. Elimination of intragroup transaction. We mentioned that one of the benefits for the preparation of or for the establishment of group of companies is to enjoy the leverage or to enjoy the benefits of intragroup trading. But we must understand that in the preparation of group financial statements, the group account should exclude any intergroup trading. For instance, if the parent company sells goods to the subsidiary at a profit, and as at the end of the year, the subsidiary has some inventory of those goods still in stock, then it means that the profit realized by the parent company cannot be realized. So any intergroup trading has to be cancelled, and then a parent cannot owe the subsidiary cannot owe the parent. It means that how much money that the parent is owing the subsidiary will be recorded in the subsidiary's book as, let's take that again. How much money the parent is owing the subsidiary will be recorded in the subsidiary's book as a current asset under trade receivables. Then how much money that is owed to the subsidiary by the parent will be recorded in the parent's book as current liability. So what we are saying here is that that money must be deducted from the trade receivables and it must be deducted from the trade payables when we are preparing the group financial statement, and any cash in transit and goods in transit would have to be also taken into consideration, and adjustment will be made for all those things in the financial statement of the parent company. That is the group financial statement. The next slide we want to look at is the group account and related party disclosure. We mentioned issues about the related party, that is IAS 27. Now, a parent company and its subsidiary or associates are related parties, and as a result, transaction between them may not be at arm's length. Even where no transactions have occurred between them, the relationship can affect how they do business. This can have significant effects on the financial performance and the financial position of the entity. Therefore, disclosures are required of the nature of the relationship and the transactions between a company and its subsidiary or its associate. So, related party disclosure has to be done. In the parent's financial statement, it must disclose that we have shares in this company, we have investments in this company, or we have contracts with this company, we advise them, they advise us. So there is a level of transaction and relationship that exists between us in relation to that. Now to the key issues about consolidated statement of financial position. So we want to look at the overview of the preparation of the consolidated statement of financial position. Now, in the preparation of consolidated statement of financial position, what we do is that, as we said earlier, we prepare a single financial statement for the two or more companies as though it is a single economic entity. Now, this implies that all assets and all liabilities of the parent and the subsidiary will be combined, since they are controlled by what? The parent. But there are steps involved in the preparation of the consolidated statement of financial position. What are these steps? There are 5 steps that we have to follow in the preparation of consolidated financial position. The first one is to establish the group structure. The group structure is just like what I have drawn here, that the parent company owns 75% share in the subsidiary, and then the parent company owns 30% share in company C, and so company C is an associate. That is what we call the group structure. So we need to first establish the group structure so that we can determine whether we are having control, whether we are having a subsidiary, or whether we are having an associate. Then also the group structure is important so that we can determine the dates that the acquisition took place or the date that the investment took place, so that we can know in the preparation of the consolidated statement of financial position whether to use a pro rata basis or to use a full year appropriation in that regard. The second thing is to determine the net asset of the subsidiary. So we are going to prepare the net asset at acquisition of the subsidiary and then the net asset at year end, so that we find out the difference between that, and that will give us the growth or decline in the acquisition. If there is growth, it means that profit is made. That is called post-acquisition profit. If it is a decline between the net asset at acquisition and net asset at year end, that one is called a decline, and that is a loss or in acquisition in the subsidiary. The third thing is to calculate any goodwill that exists. Normally, you will pay more than the net asset of the company. So if the net asset of the company is, for instance, $10 million and you are paying $25 million, it means that you are paying more. And so the more you are paying, which is the 15 million extra you are paying, is treated as what? Goodwill. So we are going to use the net asset as acquisition to calculate the goodwill of the company. Then determine any non-controlling interest. Non-controlling interest or minority interest simply refers to other shareholders of the subsidiary company. For instance, if the parent company is not owning 100% of the shares in the subsidiary company, then it means that there are other people owing other portion of the financial or other portion of the subsidiary. In that case, for this example, we own 75% share in the subsidiary. It means that there is a 25% share that is owned by another group of people, and that will be referred to as non-controlling interest. So we determine any non-controlling interest also in the question. And then the last one is to ascertain the consolidated retained earning. This is where we look at issues about impairment in goodwill. We discuss issues about proportion of the subsidiary's profits to the parent company, and then we report the group retained earnings in that case. Now, in the determination of the group structure, I've already used an illustration to determine the group structure of the consolidated financial statement. But how do we determine the net asset at acquisition and net asset at year end? What we're going to do is that, right, so determining the net assets of subsidiary. Now the net asset of the subsidiary is simply the total asset less the total liability. But sometimes it is also, or the total asset less the total liability is the same as the equity capital of the company plus the reserves. In other words, shareholders fund or in the subsidiary. So to look at the net assets of the subsidiary, remember I told you that we need to find the net asset of the subsidiary at acquisition and then the net asset of the subsidiary at year end. So subsidiary net asset at acquisition and then at year end. I'm going to pull up thousands, 3 zeros up. Then we're going to bring the equity share capital of the subsidiary. So we bring that amount here, which is usually going to be the same at the beginning of the year and at the end of the year. Then we bring the retained earnings of the subsidiary. At the date of acquisition, the retained earning will be brought. Then at the end of the year, it is going to be the retained earnings at the date of acquisition plus the profit of the year, which will be in the question. So the retained earning at year end will be the retained earning at the date of acquisition plus the profit for the year, and that will give us the year end retained earnings. Apart from that, we need to bring other reserves. Assuming the subsidiary has general reserve, revaluation reserve, share premium, all other reserves that it has at the date of acquisition will be brought. Then any one that will be at the end of the year also. If there is some at the end of the year, we will bring that one as well. But also there is going to be some time where there is what we call fair value adjustment. Fair value adjustment is where you will read in the question, or you may see in the question, where we are told that all the net assets of the company is the same as what has been recorded in the balance sheet, but maybe a land or a building or an asset has an amount below or above its book carrying value in the financial statement. So that is called fair value adjustment. So in that case, at the date of acquisition, maybe the asset or a net asset in the company has an amount below. So if it is below, then we subtract. If it is above, then we add. Now below means that the subsidiary company has estimated the value of the asset above what should be the fair value of the asset. So if we say that the subsidiary has recorded a net asset for, let's say, 2,000, but the fair market value of the asset is 1,500, that means that the fair market value of the asset is 500 below. That 500 below must be subtracted from the net asset at acquisition. But because they are recording the asset at a higher amount, that means that more depreciation or a higher depreciation will be charged. So we're going to calculate the depreciation on that particular asset, then we will bring the carrying value at the year end. Remember that this carrying value at the year end will be added to the net assets or property, plant and equipment in the consolidated statement of financial position, because when it is what? Above. But when it is below, we will going to what? Subtract it from the net asset in the property, plant and equipment from the property, plant and equipment in the consolidated statement of financial position. So that is the issue about fair value adjustment. When we begin to look at some of the questions, it will be very clear to you in that. Apart from that, we will have what we call prior period adjustment. So if there were any prior period adjustment in the question, like for instance, they have recognized an expenditure, or they have recognized an expenses, or a fraud was committed, or anything happened in the previous accounting year prior before we acquired the business, those fair value or prior period adjustment will be treated, and usually it is at the date of acquisition and nothing actually happens at the year end. So when we finish with looking at all these things, we are going to get the net asset at acquisition and net asset at year end. This is what you must understand. The net asset at acquisition will be used to calculate the goodwill. So when we are calculating the goodwill of the company or the goodwill in the subsidiary, we are going to use this net asset at what? Acquisition. Then the difference between the net asset at acquisition and net asset at year end is what we call the growth or decline. Okay? The growth or decline. This means the post-acquisition profit. That is what we refer to as the growth. So the difference between the net asset at year start and the net asset at the date or at the year end or at the reporting date is what we call growth or decline. So if the net asset at acquisition is more than the net asset at year end, that means that we are going to have a growth there or a decline. But if this one is more than this, that means that we are going to have a growth in the acquisition or a growth in the profits of the company. So that is the second thing we do. So first, we look at a group structure, we determine the group structure so that we can know the reporting date, we can know the subsidiary, we can know the non-controlling interest, or we can know if it is an associate. Then the next thing we do is to calculate the goodwill. We calculate the goodwill. So how do we calculate the goodwill of the company? Usually there are two ways in calculation of the goodwill of the company. We have the old method where we use partial goodwill calculation, and that is in your handout. And we have the new method where we use the full or the gross goodwill method. So in the calculation of the goodwill, what we do is to bring the purchase consideration. Now Now be careful here about purchase consideration. When we say purchase consideration here, it has to do with the total amount that is being paid for the subsidiary. Now there are various conditions that surround when we talk about purchase consideration. So let me spend some time on that in that regard. Sometimes the subsidiary buys, or the parent invests in the subsidiary by making an initial payment and then promising to make payment a year later or 2 years later. What it means is that in that case there is going to be a cash consideration, or a cash consideration. Then there will be what we call deferred payment. Now the deferred payment is how much the parent wants to make in addition to the cash payment that it has made now. So if there is a deferred payment that the parent acquired maybe 5,000 shares of the company, paying, let's say, $50 million, but want to pay a $20 million a year from now in addition to the total consideration, because that is the term of the transaction. That means that we will bring this $50 million as cash consideration, then we will bring the deferred payment. But the deferred payment is how much the company is going to be paying a year from now. So if it is a year from now, it is a future amount. So we are going to discount it using the parent interest implicit on the transaction, which will always be given to you in the question. So when the interest is given to us, that will be, if they are making an extra payment of 20 million, it will be 1 over the discounting factor, 1 over r exponent 1, because it's going to be 1 year. But if it is 2 exponent n, if it is 2 years, we put 2 there. If it is 1 year, if it is 1 there, or we put 1 there. Then we find the present value of the deferred payments to be made. Then we add it there. Then this will give us the total consideration. Now please make sure you understand this very well, because calculating of goodwill becomes complex if you don't understand the terms of the acquisition. So the terms of the acquisition I'm using here is that the company makes a share payment, they make a cash payment today, and they promise to make a further payment in a year from now or 2 years from now. In that case, to get a total consideration, it is going to be the cash payment plus present value of what? The deferred payment. But this is what you have to understand. This deferred payment, the company will make the payment in the future, so there is going to be a finance cost on this deferred payment. So how do you treat this deferred payment? You have to charge an interest or a finance cost on the deferred payment, because the company will pay an interest because it is making the payment in future. So there will be a finance cost on that deferred payment, which is going to be the figure you have here, the present value, times the interest rate that has been provided to you in the question. That will be the finance cost. That finance cost will be subtracted from the group retained earnings. Now these theories are very important, and I'm taking my time and trying as much as possible so that you get it down well, because if it doesn't go down well with you, you are going to struggle, and you will not be able to get that 5 mark that the examiner is going to give you for the goodwill calculation. Right. So that is the first condition about purchase consideration. Another term that can also be in the question is that acquisition is made by a share exchange. So if an acquisition is made by a share exchange, how do you treat that? Now, acquisition is made by a share exchange is where we are told that, for instance, A acquires 50. Let's just make it simple. 5,000 shares in B, paying $2.5 per share, and also makes a share exchange of, of 2 shares for every 5 shares acquired. the term of the acquisition. The parent company A acquires 5,000 shares in B, making a payment of 2.5 per share, and also making a share exchange of 2 shares for every 5 shares acquired. In this case, there are two things you have to look at: the cash consideration and then the share exchange effect. So how do you go about that? So let's look at the solution. The cash consideration in this case, it's going to be the shares you have acquired, 5,000 shares, times 2.5 per share. So 5,000 by 2.5, let me grab my Casio calculator, 2.5 by 5,000, that is going to be 12,500. But there is also a share exchange, but in terms of the agreement. So we will bring the share exchange. Now, how do we get the issue about a share exchange? What it means is that the parent company is issuing some shares to the shareholders of the subsidiary company, so that the subsidiary companies will now have share in the parent company. So they are undertaking a share exchange. Now, where there is a share exchange, we use the parent's share price to find a value for the share exchange. So in this question, let's assume that A's share price, A's share price is $3.5 per share. So to get the value of the share exchange, we are told that 2 shares for every 5 shares acquired. So if we acquired 5,000 shares, and for every 5 shares, we are going to give what? 2 new shares, times the value per share, $3.5. Are you following the picture well? So we will give 2 new shares for every 5 shares acquired. So if we acquired 5,000 shares, divided by 5 times 2 will give us the number of shares that was what? Issued. So when we do the arithmetic, 5,000 over 5, that will be 1,000 times 3.5, that will be 3,500. In this case, the total consideration will be 3,500 plus 12,500, and that will be 16,000. So in this case, the consideration is going to be 16,000. So the purchase consideration. So this is the second scenario when there is an issue about share exchange. But when there is a share exchange, you have to ask yourself to see if there is going to be an issue about share capital and share premium. Because you should know that when a company issues shares over and above the book value of the shares, then there is going to be a share premium. So when you go to the trial balance, maybe A shares is quoted at $1. But the share is quoted at $1, but they are issuing it, or they are making it a share exchange at $3.5. It means that this share exchange here would have to be treated in relation to the share capital and also share premium. So the new shares that were issued is going to be, or the share exchange is going to be 5,000 over 5 by 2. That is 2,000. It means the share exchange, so the new shares that the parent company is going to issue to the subsidiary is 2,000 shares. Now, these 2,000 shares were issued at 3.5. But the question is, we must distinguish between what must go to the stated capital and what must go to the share premium in the parent's financial statements. Because if we issue share above the value of the share, then it means that the company is making a profit. So in this case, I am assuming that the book value of the share is $1. And when we are issuing it at $3.5, that is the current market value, it means that this 2,000 share times $1, which is going to be $2,000, will go to the stated capital of the parent company. Will go to the stated capital of the company. Then that same 2,000 shares times, it was sold for 3.5, but the book value is 1, so Acca $2.5. So that $2.5, so 2,000 by $2.5, I think that should give us 5,000. Let me just confirm and see if it is true. Yes, $5,000. This $5,000 will go to the share premium account. It means the parent company is making some profit on the share exchange. Now, this is the second scenario in relation to how you find the purchase consideration in the calculation of the goodwill of the company. So what are we saying here? A acquired 5,000 shares in B, paying 2.5 per share, and also makes a share exchange of 2 shares for every 5 shares acquired. So there is a new share exchange that they are giving to the subsidiary. So to get the total purchase consideration, you must look at the cash consideration, which is the 2.5 per share they are paying for the share acquired, and then the value of the share exchange also there, and that will give you the total purchase consideration. It means this is the value of the purchase consideration. So once we have the value of the purchase consideration, the next thing we bring out is the non-controlling interest. So assuming we are not acquiring 100% of the shares of the company, then we bring the value of the non-controlling interest. Now, when it comes to the non-controlling interest also, when it comes to the non-controlling interest also, it can be valued in 2 ways. We can value NCI, which is usually what you are going to be seeing me to write in, non-controlling interest or minority interest. First it was called minority interest, but now they say we should call it non-controlling interest. So non-controlling interest can be valued also in 2 ways. It can be valued as a proportion of net assets of the subsidiary, or it can be valued as fair value of share price of the subsidiary. So these are the 2 ways that non-controlling interest can be valued, and you must look out for in the question to see which of them is stated in a question. So if it is proportion of net asset, what it means is that if A acquires B and A acquires 75% shares in B, that means the non-controlling interest in B is going to be what? 25%. So if the non-controlling interest is 25% and we are valuing non-controlling interest as a proportion of the net assets, then we will just take the net asset at acquisition of the subsidiary and we take 25% of that. That becomes the value of the non-controlling interest at the date of acquisition. But another way we can value the non-controlling interest is to value it using the fair value of the share price. This is where we use the share market price of the subsidiary. So for instance, if the total shares of the company, so A acquires B 5,000 shares, but okay, A acquires B 5,000 shares, but B's shares B's share, let me write well, but the number of B's shares is, let's say 10, no, can't be 10,000, 7,000. So the total shares in B is 7,000. A has acquired 5,000. So we need to look at the structure, okay, the structure of the group. Now, so if the whole share is 7,000 and we have acquired 5,000, then A is acquiring 5 over 7 times 100. 5 over 7 times 100, that is 500 over 7. So 500 over 7, that will be times 100. Let me take that again. 5 over 7 times 100. And that will be 71.4%. 71.4%. That's a control. Then it means non-controlling interest will be 100% minus this. So minus 100, 28.5% approximately, or 28.6% if we want to go it that way. That's the NCI, but we are valuing NCI at fair value of the share price of the subsidiary. So if the total share is 5,000, it means the NCI is 2,000 shares. So that's 2,000 shares. We will value it using the market value of the shares of the subsidiary. Okay, the market value of the shares of the subsidiary. So let's say in this case, the subsidiary share market value is $2. That means that the value of the NCI at the date of acquisition will be the number of shares they are having times $2, and that will be what? $4,000 at the date of acquisition. So that is what you have to understand when we talk about determination of purchase consideration and then bringing NCI. So once the company is not having 100% share of the subsidiary, there is going to be what? A non-controlling interest. So if there is a non-controlling interest, we can value it as a proportion of the net asset at acquisition or at fair value of the price of the subsidiary. Now, once we bring the parent consideration and we bring the NCI consideration, we get a total value of the business. Then when we less that from the net asset at acquisition of the business, we are now going to get goodwill. Now, if in the question also there is impairment on goodwill, we will subtract that impairment on goodwill. Then we will get the value of the goodwill that will be taken to the statement of financial position or the consolidated statement of financial position when we are preparing. So these are what you have to understand. First, you determine the group structure. Second, you determine the net asset of the subsidiary. Third, you calculate the goodwill, and fourth, you calculate the group retained earnings. I'm not going to go through the calculation of the group retained earnings, but basically the group retained earning will be calculated by looking at the retained earning of the parent, looking at the profit of the subsidiary. If there is any impairment, we treat it, and any finance cost, we treat it in that order. So what we want to take now or look now is to look at a question in relation to how we can prepare the group financial statement of a company.